Thank you for joining today's quarterly compliance webinar. My name is Tamalin Wandler, and I am Innovative Benefit Planning's Director of Compliance. I will be leading today's webinar as we talk through some upcoming compliance obligation and what is on the horizon in the future. Before we begin, I wanted to give a bit of information around who Innovative is. For those that don't know, Innovative is part of a larger organization called United Benefit Advisors. UBA allows us to remain independent, but does provide us with the aggregate purchasing power, knowledge, and resources of 150 firms joined together across the United States. We like to think that we are the best of both worlds. We are not a local or regional firm. We are an independent firm that has all the same access and resources as the national players do. So with that, we can jump right into today's agenda. We're going to touch on several different topics and round the discussion out with some Q&A. The first topic for today is Secure 2.0. Secure 2.0 Act was passed in 2022 and builds on the previously enacted Secure Act of 2019. Recognizing that there is a looming retirement crisis in the U.S., Secure 2.0 implements significant changes to retirement plans across the board, but for the purposes of today, I'll just be touching on a few changes that will impact 401k plans and 403b plans specifically. The first item I want to mention under the Secure Act is effective 1/1/25 and is a mandatory change for employers sponsoring a 401k or a 403b plan, and that's to changes related to long-term part-time employees. Previously, long-term part-time employees working 500 hours to 1,000 hours consecutively for 3 years were considered long-term part-time employees and would be eligible to make employee contributions to the employer's 401k plan. With the change effective 1/1, the years of service requirement was decreased to only 2 consecutive years, and the applicability has been extended to 403b plans. I also want to note that these requirements do not mandate that plan sponsors make contributions on the long-term part-time employee's behalf. The only requirement is related to the employee's contribution. With that said, a plan sponsor is able to make contributions if it chooses to do so. Here we have a few employer considerations. Employers should review their eligibility requirements to determine how part-time employees are currently being handled and address gaps if necessary. They should also confirm with their payroll provider and record keeper that the appropriate mechanisms for tracking hours are in place, and then determine how they will notify employees about the new eligibility rules. One final thing I want to touch on here is how employers should address a missed long-term part-time employee's enrollment. So there is no required correction if the error is identified within 3 months of the date the employee became eligible. However, if more than 3 months have passed, it is recommended that the employer make a corrective contribution to address the issue. Here are a few notable employer impacts that were also pulled from the statute. The first 2 are optional, whereas the last 2 are likely mandatory. The first you may have heard about is related to student loan 401k matching. Effective for plan years beginning 1/1/24, employers were allowed to treat an employee's qualifying student loan repayment as retirement contributions for the purpose of the plan's matching contribution. The reason for this is that there is a recognition that many people that have student loan debt do not necessarily have additional funds that could be put towards their retirement. The second item here is related to emergency withdrawals. Effective 1/1/24, plan sponsors of 401k and 403b plans were able to offer distributions with no early withdrawal penalty for victims of domestic abuse, those diagnosed with a terminal illness, and other personal emergency expenses. Assuming the expenses qualify, eligible participants may receive distributions of up to $1,000 once per year. Another provision we've highlighted isn't effective until the end of 2025, but one to be mindful of. Effective 1/1/26, individuals meeting the salary threshold who are eligible for catch-up contributions will need to make them to a Roth account on an after-tax basis. While a participant will lose the upfront tax break associated with pre-tax contributions, the Roth funds can be withdrawn tax-free in retirement. This requirement was initially effective 1/1/24, but recognizing the administrative burden it puts on plan sponsors to implement, the IRS delayed until 2026. The last change I'll speak about today is related to catch-up limits. Effective 1/1/25, the catch-up limit for folks aged 60 to 63 will be the greater of $10,000 or 50% more than the regular catch-up contribution for the year. As with essentially every change that's made to an employer-sponsored plan, there is a need to update the plan document accordingly should the plan sponsor opt to make changes. That we will move into a few items related to the Consolidated Appropriations Act of 2021. One of the provisions of the CAA requires contracts between plan sponsors and their insurers to be free of gag clauses. This is applicable to medical, RX, and behavioral health contracts. A gag clause is a contractual term that prohibits certain information from being shared. The spirit of many of the health plan related provisions under the CAA are to increase transparency between plan sponsors and their carriers, which will in turn theoretically provide more insight into the cost and the quality of care. Plans and insurers will need to upload a compliance attestation to CMS's website on an annual basis by December 31st. Some carriers are handling the attestation on plan sponsors' behalf, while others are not. If that is the case, the plan sponsor will need to upload an attestation on their own behalf by December 31st. Regardless of whether the carrier is uploading for the plan sponsor or not, they should be providing all of their groups with confirmation that their contracts do not contain gag clauses. If you receive one of these confirmations, I recommend keeping it for your records just in case. Under the Mental Health Parity and Addiction Equity Act, or MAPIA, employers are required to conduct non-quantitative treatment limitation, or NQTL, analyses. This requirement was effective February 2021 and has created some confusion for employers. For those with fully insured plans, the requirements would fall on the carrier. But for those sponsoring a self-insured plan, the testing responsibility typically falls on the employer. The final rules provide additional insight into the implications of a final determination of non-compliance. In the event the group health plan receives this determination from the DOL after engaging in the corrective action process, the plan may be required to notify the plan participants and beneficiaries of the determination within 7 business days, remove all NQTLs for mental health and substance use disorder benefits, and/or pay civil monetary penalties in accordance with the facts and circumstances surrounding the violation. The timing of providing the DOL with the analysis upon request is tight. Plan sponsors have 10 days to provide the analysis report upon request, then an additional 10 days to provide additional information, and finally they have 45 days to provide a corrective action plan and updated analysis if they fail to comply. Plan sponsors will need to attest that they engage in a prudent process in selecting qualified service providers to conduct the analysis and be ready to provide this attestation upon request. As part of the final rules, the DOL has stated it intends to update the self-compliance tool to provide a robust framework and roadmap for plans and issuers. With that said, relying solely on the self-compliance tool may not be enough to satisfy the requirements. Employers should weigh their options to determine the best approach. The next requirement under the CAA is related to what is known as the RxDC reporting. So effective December 27, 2022, employers' health plans will need to report certain information to the federal government related to prescription drug costs. In addition to reporting general information regarding the plan or coverage, plan and issuers must be prepared to provide, among other things, detailed information regarding the 50 most costly drugs, the 50 most frequently dispensed drugs, and the 50 prescription drugs with the greatest increase in plan expenditures. This provision also requires the department to issue biannual reports on prescription drug reimbursements under group health plans, prescription drug pricing trends, and the impact of RX costs on premium rates. Self-funded plans may enter into written agreements with TPAs and PBMs to submit on their behalf, but should be mindful of their liability. This reporting is due annually by June 1st. This requirement was effective for contracts after December 27, 2021, but I included it here because it's an ongoing requirement and something to be mindful of. Plan sponsors should receive a compensation disclosure from their broker or consultant for contracts that were entered into, extended, or renewed after the effective date. An updated notice will also be required within 30 days following the discovery of any inadvertent errors or omissions, within 60 days of a compensation change, and within 90 days of a client request. While this is largely a requirement for the broker or consultant, ERISA prohibits plan fiduciaries from engaging in certain transactions with parties of interest and fiduciary self-dealing. In many cases, the plan fiduciary is the sponsoring employer, which means that if you receive a disclosure and do not review it carefully, you could be at risk of potential litigation. Under ERISA, employers are considered fiduciaries in their role as health plan sponsors and administrators. Certain other individuals, like a person, committee, or entity, or a service provider, may also be named as a fiduciary in the related plan documents. At least one fiduciary must be named. On this slide, I have a few employer considerations when considering your obligations as a plan fiduciary. One of the most important steps for a fiduciary to take is to first establish a fiduciary committee that is dedicated to health and welfare benefits, and then to delegate responsibilities to each member of the committee. Fiduciaries should review their agreements with their carriers and document their policies, procedures, and decisions related to vendor selection and performance monitoring. On this next slide, we will spend a few minutes discussing some of the pending fiduciary class action lawsuits. Here we have some information around some pending class action suits that have been brought as a result of the transparency rules under the CAA. The J&J and Wells Fargo lawsuits were filed earlier in the year, and both allege the plan sponsor breached their fiduciary duties to plan participants and beneficiaries with respect to the prescription drug plans. The most recent lawsuit involves the employer, Owens & Minor, and their carrier, Anthem. This suit differs from the other class actions we've seen in that it is the employer who filed the suit against the carrier rather than the plan participants and beneficiaries. While it is unclear how these suits will be resolved, their existence highlights the importance of taking necessary steps to ensure your plans are running effectively and consistently with the plan's overall structure. We will now briefly discuss a few updates related to HIPAA. So moving right into some of these updates, specifically a final rule related to reproductive healthcare privacy was released that may have an impact on the employer. HIPAA-covered entities and business associates will be required to obtain signed attestations when they receive a request for reproductive health care PHI that the use and disclosure is not for a prohibited purpose. The attestation requirement is one of the biggest changes this final rule has on HIPAA-covered entities and business associates. The attestation requirement applies when the request for PHI is for health oversight activities, judicial and administrative proceedings, law enforcement purposes, and/or disclosures to coroners and medical examiners. This attestation must be signed and completed by the person requesting the reproductive health care PHI and is limited to the specific use or disclosure, so each request will require its own attestation. So with all of this in mind, what are the action items? So by December 23rd, HIPAA-covered entities and business associates will need to be prepared to comply. Policies and procedures and business associate agreements should be updated to address the new requirements. The attestation process should be implemented, and employees who handle PHI will need to be informed of the changes and trained on the new process. The second implementation date is February 16, 2025. By this date, the Notice of Privacy Practices that HIPAA-regulated entities distribute will need to be updated to reflect the changes and then redistributed. Some employers are able to rely on their carriers for this requirement, so it is important to confirm who typically handles the distribution of this notice. We have resources on our website to assist and are able to answer any questions should you have them. One final HIPAA-adjacent item is related to the DOL cybersecurity guidance. The DOL released cybersecurity guidance and best practices in 2021, which were then slightly updated in 2024. While the edits to the guidance were limited, the fact that the DOL made updates reiterates that cybersecurity is a major priority for the DOL. Additionally, the updated guidance clarifies that this is applicable to health and welfare plans as well as other ERISA-covered plans. I've also included a few employer considerations. Employers should maintain a formal cybersecurity program and policy and periodically engage in a self-audit to ensure the policies are being followed. It is also important that the employer confirms that their service providers are also adhering to their policies. As I mentioned previously, the plan sponsor is the plan fiduciary, so in the event of a security breach, it may ultimately be the plan sponsor that is facing the liability, so preemptively preparing for any issues that could arise is a must. On our next few slides, we'll go through a few legislative updates. The first legislative update I wanted to touch on is related to fixed indemnity plans. A fixed indemnity plan is an accepted benefit plan that does not provide comprehensive health coverage. Instead, these plans provide income or wage replacement benefits that can be used to cover out-of-pocket expenses that are not otherwise covered by health coverage. The reason this is coming up is that plan sponsors sponsoring a fixed indemnity plan will be required to provide notice that the plan is not health insurance to employees on any applicable marketing material or enrollment/re-enrollment material. The notice should be prominently displayed in 14-point font and is effective for plan years beginning on or after 1/1/2025. To ease the potential administrative burden to employers who need to provide this notice, a model notice has been created. This next item is hot off the presses from within the last week. There are two new pieces of legislation that have been passed by the House and Senate related to reporting obligations under the ACA. This first item is the Employer Reporting Improvement Act. This act is set to ease reporting burdens for employers who need to file Forms 1095-B or 1095-C. Specifically, the law would codify the IRS practice of allowing employers to use spouse and dependent dates of birth instead of their TIN or Social Security number on the forms. Additionally, it would also solidify the ability for employers and insurance providers to distribute the forms electronically to covered individuals. Both of these flexibilities have been the IRS's practice previously. However, this law would make this permanent. Additionally, the law would extend the response time for IRS assessments from 30 days to 90 days and provide a 6-year statute of limitation for the IRS to collect penalties. Both of these items would be welcome changes for employers as it provides additional flexibility in the event of a 226J penalty letter. The second bill is the Paperwork Burden Reduction Act. This act would eliminate the requirement for employers and health insurance providers to distribute Forms 1095-B and 1095-C to each covered individual unless it was requested. Both of these acts are in front of the President for signature. And with that, we will move into a few slides regarding Affordable Care Act reporting. I'm sure you are already aware of your reporting obligations under the ACA, so I won't spend too much time here, but did want to mention a few things. First is related to the requirement for employers to offer minimum essential coverage. This requirement means that employers with 50 or more full-time or full-time equivalent employees must offer minimum essential coverage to at least 95% of their full-time employees. If you are not offering this coverage or any of your employees receive a premium tax credit for subsidized health insurance through the marketplace, you could be opening yourself up to being penalized by the IRS. Penalties under this provision are known as A penalties. For 2025, the penalty would be $241.67 per month per full-time or full-time equivalent employee minus the first 30. This is a decrease from last year, which is welcome. However, it does not indicate that the IRS is lessening its enforcement efforts, so employers should still be vigilant when reviewing their eligibility requirements and forms to ensure they are complying with the rules. The second requirement under the employer mandate requires employers to offer affordable minimum value coverage. Minimum value coverage is provided if it covers at least 60% of the total allowed cost of benefits. For plans beginning in 2025, the affordability threshold was increased to 9.02% of an employee's household income. The affordability threshold is used to determine if an employer's lowest premium health plan meets the affordability requirement. This is an increase from the 2024 threshold, which saw a steep decrease from the 2023 threshold. The penalty associated with this provision is known as the B penalty. For 2025, this penalty is $362.50 per month per full-time employee who receives a subsidy through the marketplace. So unlike the A penalty, the B penalty doesn't apply to every single employee. It only applies to those who get the subsidy. The next two slides are related to the actual due dates for the reporting. Employers filing their 1094s and 1095s by paper with the IRS will have until February 28, 2025 to do so. And then they must furnish the appropriate form to employees by March 3rd. The deadline to file with the IRS electronically is March 31st for 2025. Employers filing 10 or more returns are required to file electronically. There are a few states that have their own filing requirements. New Jersey, DC, and Rhode Island's due dates are similar to the federal in that the due date to distribute to employees is March 1st and to the state is April 2nd. Massachusetts has the same employee deadline, however the deadline to file the MAHC 1099 is January 31st. Finally, California's due date to distribute to employees is January 31st, but the date to submit to the state is March 31st, which is in line with the federal rule. The remaining slides in this presentation are going to look at some items that are on the horizon in 2025. The first item I wanted to touch on is related to Medicare Part D reporting. As you likely know, there were changes for 2025 related to Medicare Part D, which resulted in a number of employer plans being deemed non-credible that were previously deemed credible. As a reminder, an employer is under no obligation to have creditable coverage. Their only obligation is that they inform individuals whether the coverage is creditable or not. In addition to the requirement to send the notice to individuals, employers are also required to submit creditable coverage status to CMS within 60 days of the beginning of each new plan year. Separately, group health plans are also required to submit details about individuals enrolled in both Medicare and the employer's health plan. Typically, this reporting is handled by the insurer or the TPA. However, in cases where the plan is self-insured and self-administered, the plan administrator will likely handle the submission. This next slide is related to telehealth flexibilities for high-deductible health plans that allowed high-deductible health plans to cover telehealth visits at zero cost share prior to meeting the plan's deductible. We saw this flexibility initially as a result of the COVID-19 pandemic, and then in 2023, a 2-year extension was granted, which would make the flexibility sunset at the end of this year for calendar year plans. For non-calendar year plans, the flexibility will continue until the end of the 2024-2025 plan year. There are rumblings that this flexibility will be extended again, and there have been talks about a last-minute healthcare spending bill making its way through Congress. However, it is unclear what will happen by the end of the year, if anything. With that in mind, it's important for employers that have allowed this change to review their plans and ensure the necessary updates have been made prior to the end of the plan year. Another high-deductible health plan related item is the new guidance that was released, which expanded the list of preventive services that are provided through the high-deductible health plan at zero cost share. The first is Notice 2024-71, which provides a safe harbor under Section 213 of the Internal Revenue Code for amounts paid for male condoms. Specifically, this would allow amounts paid to be eligible for reimbursement under the plan's HSA, FSA, or HRA. The second notice is Notice 2024-75, which expanded the list of preventive services to include over-the-counter contraception, male condoms, continuous glucose monitors, insulin, and breast cancer screenings. Plan sponsors should review their plans to ensure these updates have been made. Moving on to some leave-related items. The first here is the Delaware Paid Family Leave. Under this law, beginning 1/1/26, Delaware workers will have access to paid medical leave through the state. Employers will be able to participate in the state-run program, or they can self-insure or fully insure a private plan. Employers would have needed to opt out of the state program by December 16th. For employers requiring employees to share in the cost of the plan, payroll deductions will begin 1/1/25. The first due date for paid family medical leave contributions is April 30th, and benefits will begin 1/1/26. Starting 1/1/25, employee contributions to New Jersey's temporary disability insurance programs will resume, and employee contributions for family leave insurance will increase. Tax rates will be increased for 2025 calendar year to 0.33% for family leave insurance and 0.23% for temporary disability insurance. Family leave insurance has had an employee contribution for years. However, the increase from 0.09% to 0.33% is relatively significant, so something to keep in mind. The biggest news here is the reinstatement of the temporary disability insurance employee contributions. These contributions were stalled for the last few years, so to jump from 0% to 0.23% is important to note. Maryland has also enacted a family and medical leave insurance program, which is set to begin payroll deductions for the state program on July 1st, 25. The first payment to the state must be made by October 1st, 25, and benefits will be available to employees on July 1st, 26. Finally, New York has increased the employee contribution rate to 0.388% of gross wages per pay period effective 1/1. Additionally, mandatory benefits have been expanded to include paid lactation breaks and additional paid leave for prenatal care. In light of the constant changes around leave policy, I wanted to provide a few high-level tips for employers who may be subject to these rules. The first and arguably the most important is to develop clear policies around leave. The policy should be implemented consistently for all eligible employees and communicated in a manner that ensures employees understand what they are eligible for and the process for making leave requests. Additionally, employers should ensure that they have trained their managers effectively and continuously monitor the effectiveness of their policies. I want to quickly note a few of the contribution and fee amounts for 2025. Each limit has been adjusted for inflation and increased slightly. For high-deductible health plans, the maximum out-of-pocket will be $8,300 for self-only coverage and $16,600 for family. The maximum HSA contribution for 2025 is $4,300 for self-only and $8,550 for family. Additionally, the annual contribution limit for healthcare FSAs is $3,300, and the dependent care FSA limit remains unchanged at $5,000. The transportation fringe limit will be $325 in 2025. Finally, the updated PCORI fee amounts have been released. For plan years beginning on or after October 1st, 2023, and ending by September 30th, 2024, the fee amount is $3.22 per employee. For plan years beginning on or after October 1st, 2024, and ending by September 30th, 2025, the fee amount has increased to $3.47 per employee. A few additional employer responsibilities here to keep in mind as we near the end of 2024. Employers who offer health insurance plans must provide SPDs to all participants. For new participants, the SPD must be provided no later than 90 days after the person first becomes covered. For new plans, the SPD must be provided within 120 days after the new plan is adopted. Employers also need to be mindful of their annual notice requirements and their obligation to send the required notices to plan participants. There are several notices that are required on an annual basis at varying times of the year, so it's important to be mindful of this. Employers are also required to conduct non-discrimination testing of their health and welfare plans on an annual basis. This testing is similar to the requirements on the retirement plan side and is applicable to self-funded health plans, group term life plans, cafeteria plans, dependent care assistance plans, tuition reimbursement plans, and adoption assistance plans, so it is a lot. The most volatile testing is under Section 129, which is applicable to dependent care assistance plans, so at a minimum I suggest conducting that testing on an annual basis if you opt to conduct testing for your other plans at a different interval. Moving on to HIPAA privacy and security. Typically, employers are required to conduct annual HIPAA training for all staff members who have access to protected health information. Additionally, employers should also ensure the necessary privacy and security policies and procedures are in place and consider conducting a HIPAA audit if you haven't recently or ever done so. With the way that data is shared and the constant concern of hackers, it's important to ensure your PHI is safe. Additionally, as we discussed previously, there are upcoming changes related to the use and disclosure of certain PHI, so it is important that HIPAA-covered entities and business associates are making the necessary adjustments. Finally, some next steps. As always, continue to monitor for updates and discuss with your vendors and TPAs how potential changes may impact your plans. We talked a lot about this push for transparency, so you want to be sure to confirm with carriers that the required transparency reporting is being handled appropriately. And finally, consider working with a vendor to prepare a MAPIA and QTL analysis. It's better to have it ahead of time so you can make corrections before you get the audit request from the government. As always, Innovative is here to support you with any of your questions and needs, so if you do have any questions, please don't hesitate to reach out. Thank you for joining our webinar. Here are a few of Innovative's upcoming events. We hope to see you there.